So this is the at the contract inception you have to evaluate whether it is a distinct and whether it is a separate performance obligation. Now how do you say whether the product level they are distinct? So to be product level distinct, you need to either benefit on its own or together with available resources. Like your car parking and your building, independent, distinct, because car parking you can take from somewhere else, building you can park the vehicle outside. And then you need to check entities promise. See, that means they are talking about the product test here, contract test here. So you have to evaluate any contract and see how many promises are there in the contract. Is it product level distinct? And then see at the contract level, did you promise the distinct what is at the product level, or you wanted to combine and promise something different? Depending upon that, you can define how many performance obligations are there. This is the theory you write. Now let us evaluate one by one. Common area. Can you sell that separately? Yeah, in the context of goods or service, you can sell. No? Common area in the mall, I told you. We can think about a mall. Can you take the property without the common area? You can take. Like suppose common area you want to give to somebody else. You just have a right to walk. But the common area may be owned by the, common area may be owned by the contractor. Contractor says, look, what I will sell you is one room. I'm not selling you common area. So tomorrow, contractor permits me to walk over his common area to access this. But whether that common area should be used to give the set up one ice cream shop or whatever, your SIM mobile repairing, who gets that right? Contractor has got a right. Or you may say, sir, give it to me. That means my shop, in front of my shop, my common area is my property. That means is that property and common area are one or both are distinct? Like at the product level distinct. Followed, no? So if it is distinct in the contract also, then it is a separate performance. Yeah, now question comes when you see what you have purchased, what the customer has purchased, whether the customer has purchased only property or property plus common area. Now, if it is only property, there is no question, but you have purchased property with the common area. Now, in that common area, you may have permitted other people to walk around, but the property belongs to you. Now, tomorrow, whether that ice cream shop will be set up in the common area or not, who has to take the decision? Who will get the cash from that shop? You will get, because you have purchased it. Now, both are distinct or both are one performance obligation. That's what we don't know. We have to say that, look, at a product level, they are distinct. But at the contract level also, if they are distinct, both are unrelated to each other. If there is a two-way dependency is not there, significant customization is not there, then that is different, this is different. There are two separate performance obligations. But if you cannot sell them separately, that means whoever purchases this has to purchase that. Or whoever purchases that has to purchase this. Two-way interdependency is there. Then it is a single performance obligation, not a separate performance obligation. Means it is a single performance obligation. Have you understood? We don't know, question is very silent here, which property, which floor it is located, what they are doing. So we will also give a very generic answer. But have you understood the answer here? Now construction, service and building. Yeah, definitely here though it is impossible. No? Context of a goods and services, yes, they can be used along with readily available resources. But in the context of a contract, there is an integration happening between the construction service and the building. You can give your construction services to third party. Building can be constructed by third party. But when you sell it, suppose you are the builder, I am your customer. You have sold me the building. In building, there are two things. No, one, you have got a building property. Second, you have got construction services. Can you separate this portion and say that there are two elements? You can always see, you can draft the contract anyway. Instead of telling 10 lakh rupees for the building, what you are telling, 8 lakh rupees for the building, 2 lakh rupees for the service contract. You can tell that. Now, if you tell like this, at the product level, are they distinct? Yes, at a contract level. No, because you cannot have a building without integrating these construction services. So there is a, because of the integration happening, even though in a contract you say there are, I will give you two, but it is one performance. That's what I started today. Your one contract can have multiple products, but one performance obligation. It can be one product, but can be a multiple performance obligation. Property management services and gold membership. That means along with the property, you have taken one property like cleaning. You have got one golf club there. Now, who can be the golf member? The one who holds the property. Or third party also can become the member by paying the membership fees. But as per the contract, you have purchased the property plus golf membership. Is it one performance obligations or two different performance obligations? Two different performance obligations. That's what they are likely to be separate. Are we understood? No? In the context of a contract, they are distinct. It is not inseparable. Followed, no? But it's separable. You could have separated, like you could have sold only building, not the membership. You could have sold only membership, not the building. But at the contract level, there is no customization, no integration, no dependency. So how can you say that your golf membership and property is one performance obligation? Your golf property, that's why you bifurcate into two performance obligation. On property, you will recognize sales the day it gets registered. On golf membership, you recognize the revenue over a period of time. One is at a point in time, another is over a period of time. Now, what you are planning, you are clubbing both, and something which should have recognized over a period of time, you are recognizing at a point in time. Or something what you should have recognized right now, you are spreading it over 1 year. That's why it's very important. We have to understand how many performance obligations are there, and we have to accordingly we have to bifurcate the revenue. Car parking and land entitlement. Okay, now in the context of goods, yes, they are capable being distinct. Buyer can benefit on its own, or you can, because when you are given one land entitlement, like I told you previously, on this land there are flats. It can be, arrangement can be such a way that you have purchased only flat, not land. Land belongs to the contractor. Alternatively, he has sold you one flat and the proportionate land. No, parking lot is a different thing. Maybe parking is located outside. In the property on which the land on which the property is built, one portion may be in your name. See, with that one sense, you can't do anything. But what you can do? Can you pledge this 1 cent with the bank and take a loan? Yes, because you have got entitlement, no? That's why it has got a standalone functionality. So if you can sell land entitlement alone, that means tomorrow, 1 cent you can sell to third party, but you retain the property. Can you do that? You can do it, no? Like, see, when the contractor himself can retain the land and give only property, alternatively, all the property owners can decide together to sell the land but maintain the property, no? Those arrangements can happen. That's why if the land entitlement can be sold separately, or it can be pledged as a security, it says that it is not dependent or integrated. That's why it's a separate performance obligation. But if you cannot sold this separately, undivided interest in the land is highly interrelated, so it's not a separate performance. So if you can't, it doesn't have any standalone functionality. That means your property is there, it's proportionate land, you are the owner. But without that property, you cannot do anything. That means if you want to go to the bank to pledge, bank manager will say, along with this land, give me the properties documents also. If manager is going to insist that, that means that land is useless without property. So it is integrated. Are you clear? So by now, I hope you are very much clear about the performance obligations. How many performance obligations are there? Yes, so easy. Now we will move on to the third element called the determination of the transaction price. Okay, here we have got some calculations. Problems are there, but again, first we will start with the theory and then we can look into the problems. Yes. Transaction price means what? Have you used this word anywhere? Yeah, price of the transaction. Like in 109, we were always telling transaction price. It is the amount of consideration to which a entity is entitled to for exchanging of the goods and service to the customer, but excluding any amount collected on behalf of the third party. That means if you have collected GST to be payable to the central government, now GST received is not your consideration. Other than that, for whatever goods and services you have given, if you are going to get any cash, that is the transaction price. Now, what all the components will be there? In determining the transaction price, you need to consider, see, fixed to direct by define. We have agreed to for a fixed consideration. Fixed consideration will come. But there can be possibility that there can be a variable consideration. What is variable consideration? We don't know. It can happen depending upon the events happening in the future. Now, I will sell one that is called a watermelon piece to you. One watermelon piece, 10 rupees. What you will give me? 10 rupees you will give me. It is a fixed consideration. But if I tell you, you give me money only if you like it. You give me money, 10 rupees, only if you like it. Now the fixed consideration turns into a variable consideration. Because my right to receive this consideration depends upon certain events on which I don't have any control. Sorry? It is like a contingent consideration. Yes, exactly. Then you can have a significant financing component. In 16 also, we always try to remove that financing component whenever it is sitting. So we have to remove here also. Non-cash consideration, like other than cash we will pay to the supplier. Have you come across such situation? Where? Where you have done that? Car, best example. You give your old car along with additional cash and you get, or you give your old cloth and get one steel utensil. It's a barter. Okay, that's what we are going to talk about, how to value that. And consideration payable to the customer, like discounts, coupons, okay, cashbacks. So these are all the four scenarios we need to address, because fifth scenario is a fixed consideration. There is no headache in every question. Fixed consideration, straightforward. Now let us talk about the variable consideration. Now an amount of consideration can vary because of the discount, rebates, refund, credit, price concession, etc. A fixed variable consideration may be fixed in amount, but entities' rights depend upon the contingent future. Like if you complete early, you will be given 1 crore rupees. Amount is fixed, but I am not sure. The treatment of the discounts and rebates will be very similar to consideration payable to the customer. So when it comes to the discount, you treat it like a consideration payable to the customer, or you treat like a variable consideration, one and the same. So what you need to do whenever you have got a variable consideration in the transaction? Generally, no, maximum time, every place fixed consideration only. You go to hotel, it's a fixed consideration, a menu is there. They tell you the fixed price. So if you have got a variable, then you have to estimate and constraint. Very important theory. The variable constraint for the purpose of revenue recognition. Then which all methods are permitted for me to estimate it? There are only two methods are permitted, called expected value method and most likely outcome method. Many practical questions are there on this particular aspect. And I'll show you how examination questions will be framed very intelligently. Now what is expected value method? Sum of probabilities, like my 3 scenarios are there. How much money I may get? 50 rupees I may get, 30 or 5. Probability is so and so. You multiply all the 3, you get the expected value. And where it is suitable? When you have got large number of similar contracts. Most likely method is suitable only when you have got 2 possible outcomes, like you will get bonus or you will not get bonus. What is the probability you will get bonus? 90%, no? So this full amount you take. In this step, you multiply individual values and take the outcome here. Like in AFM we used to do, no, portfolio management. That was expected likely method. where individual sales returns, you multiply with the probability. In a most likely, you don't multiply among all the probability, which is the highest probability? 90. In this case, 60. So you take full 50. That is called. Now either you will get, you will not get. So you say which is highest probable, you take that, because somebody will say, no sir, this is meaningless. No sir, you multiply with the probability, it's a meaningless number. But there are two ways of estimating. You can choose one among the two methods, but whatever you choose, you should choose it very consistently. Followed, no? Now everywhere, wherever variable consideration comes, you have to write one theory in the exam. It's called constraining the variable consideration. Now the moment you have got a variable consideration, can you include everything in your transaction price? No. The standard says an entity shall include some or all amount of variable consideration only to that extent when you are highly probable that reversal is not going to happen in the future, when the uncertainty associated with the variable consideration is resolved. Today you will say, oh, that you will always feel like taking 50 because probability is very 90. No, you have to again think. It's just a theory, okay? No practical implications there from exam point of view. It's called constraining the variable consideration. That constraining means restricting it. So you have to take only those portions which you really think will not get reversed. That means simply don't, which will not reversed. Like today you said, oh, I will take 50, but after 1 month you realize, or after 6 months you realize that you cannot complete. Then whatever you have posted one entry, no, customer account debit to revenue, after 6 months you have to reverse it. Unnecessary you inflated P&L, no, sometimes 6 months back. That's why you should not do it. And what is the probability? Factors which includes the likelihood of the amount reversal. What are the factors you should see? You should see really, is it within entity's control? Like stock market related bonus. It is not within my control. Completion bonus. It is within my control. Uncertainty about amount not expected to be, like there is some challenge and you think that for next at least 2 years it will not get resolved. It has got stuck somewhere. Or entity's experience, you are doing your for the first time. Better don't consider the variable consideration unless you get the clarity. Because you are doing it for the first time, you cannot estimate it. Or there is a broad range of plausible considerable. That means this can happen, this can happen, this can happen, this can happen. So in such circumstances, don't get in estimations. So these are all the factors which will help you to make a judgment when you think most likely method or estimated value method. That output should you include or should you reduce that? It's just you have to write a theory. Now reassessment, since you have not included everything, or even though you have included everything, every year end you have to update the estimate. Followed, no? You have to update the estimate every year and see whether you can include something extra. Okay, let us see, is there any theory questions? Variable considerations. Okay. A construction company, it's a 2-mark question, means not that important. Construction company enters into a contract with the customer E to build an asset. Is there any contract? How many performance obligation? 1. Very good. Depending at which level? Product level or contract level? In a product level, how many? We don't know. At a product level, build an asset means at a product level there must be many distinct something, but at a contract level it is 1. Okay. Now we will go to the third step. What is transaction price? Depending upon when the asset will be completed, C will receive 1,10,000 or 1,30,000. So first thing, is there any fixed consideration? No. It's a fixed consideration but variable. Is it a variable consideration? Yes. How much variable I should include? No. Your answer should be, sir, we have to estimate how much we should be including. How do you estimate? For this, we have to follow one among the 2 methods. Which method? Most likely method or expected value method? Which one you will apply? Most likely. Why? Because there are only 2 values available here. So they have given you the probability. What is my transaction price here? What should I include on day 1 Because I may, as and when I construct, later you will get a better idea, okay? Once you revise this, it becomes, you understand it very clearly. There is last step called revenue recognition. In intermediate, have you done construction contract? You had this percentage of completion method, no? Same thing we may apply here also. But to apply that percentage of completion method, we need one figure, right? Contract value, contract, what do you call for that? Contract price. Contract price is nothing but transaction price. So, what is the transaction price? It is 1,30,000. So, there are only two possible outcomes are there. So, 1,30,000 is the single most likely outcome. That's why we will take that as a contract price. Sorry? We are taking because this is probability is very. No, that if you want, you could have done that also. That's called expected value method. But you have the standard will not. Let us go to the management judgment. Which one to follow? Next question. Understood, no? A contractor enters into a contract to build an asset for 1 lakh. Performance bonus will be 50,000 rupees. That will be paid based on the timing of completion. So, how many considerations are there? How much? What is that? Fixed consideration 1 lakh. 50,000 is a variable. So, definitely 1 lakh, so definitely you will include because you have got a right over it. But 50,000 should you include? I don't know. We have to estimate it. The amount of performances decreased by 10% per week for every week beyond agreed completion. And that means it is not 50. It is 50, 45, 40, depending upon how fast you will complete. If it delays, then after some time you will not get anything on it. If you take delay only by 1 week, instead of 50, you will get 45. The previously management believed that it had a experience predictive, believes that such experience is predictive for this contract. The contract concludes that expected value is the most predictive in this case. So, it has to predict now. Which method they will choose? Expected value method. They estimate that there is a 60% probability contract will be completed within the date, and the 30% that it will be completed within a late, and 10% that it will be completed 2 weeks late. What is my transaction price? Use your calculator and tell me. What is my transaction price here? 1 lakh is fixed only. Yeah, which one? How do you calculate? Yes, tell me. What is my expected value? That's what they are trying to ask you here. Sorry? 27? Total transaction price. 1,27,000? 1,47,500. 550. Others? And they asked you just to determine the transaction price. They didn't ask you theory about how many performance obligation, is there a contract. So first of all, is there any fixed contract? Yes, variable is there. So expected value you are going to use. $1,47,500. Is that understood? Sorry? Yeah, but are you going to get this 50? Performance is going to complete in the future. But when you talk about a percentage of completion method, you should consider this also, no? Because, or will you suddenly recognize on last moment? If you have to do this complete, the work starts from now, no? So you cannot say that I earned only in the last 4 months. Later comes because of your actions today, no? Or you sit and delay, will it come to you? So expectation is you have to spread this over a contract period. What's the fastest? That's what I should. But whichever fast you do, there is one cutoff. That 50,000 minimum you will get if you complete that. That means you should spread it over. So how much you got? Yes, Prithvi. Yeah, so how do you do it? First you will explain that there is a variable consideration. You have to estimate it. which method you will choose? Expected value, because they only told you. And you need to update from time to time. So on day 1 or whenever you find out the percentage of completion, fixed consideration 1 lakh you take plus variable. See, there is a 3 possibilities. Either you will get 50, or you will get 45, or you will get 40. They will roll 3 possibilities. It will get delayed by 1 week, 2 weeks, or 3 weeks. ₹40,000. Understood. Then you understood. Your assumption is, see what they have taken, 10% means 10% on 50. You have taken WDV method. Doesn't matter. Question is silent. Now they told you that will be the amount will be decreased by 10% per week. They didn't tell you very specifically. So some students could have taken that assumption. What they have taken into 10% means 5,000 will get reduced on a staggered basis. So you get 1,47,500. Understood now? Simple. This question comes, you should be happy, but I will show you exam questions. Exam questions are a little tricky only. But without understanding this, you cannot touch that. See, and more. Electronic manufacturer sell 1,000 televisions to the retailer for ₹50,000. Every 50 lakhs, every television 5,000 rupees. M provides price protection to R by agreeing to reimburse any difference between 5,000 and the lowest price that offers television during next 6 months. Let me see. You are the Onida TV seller. There is a LG. Now your prices depends upon LG's price. You are fixed 5,000, and one dealer has purchased 1,000 TVs. At that time, provided LG also must have been 5,000 only. That's why he purchased from you at 5,000. If tomorrow LG makes it 4,000, who is into soup now? Dealer is into soup. Company has already sold. And 5,000 rupees, who is going to buy an Onida TV there? Because when the LG is selling at 4,000. And if company doesn't speak anything, dealer will never buy 1,000 from you. He says, sir, there is already risk. Why I should take this risk? That's why Onida tells this dealer, look, today you buy at me from 5,000. If at all, they will reduce the price. How much they reduce, that much discount I will give it to you, so that you can also reduce the price and sell at 4,000 rupees. If LG reduces the price, they will reduce say 5 by 1,000 rupees. I will also give you discount. Now who is into soup? Now it's a competition between LG and Onida. Otherwise it will end up as a competition between dealer and LG there. Dealer cannot sustain only. That's why company gives an offer and say that it will reimburse to our retailer the difference between the price of the competitor and the lowest price that offers television during next 6 months. There's one clause, okay. Now based on the EMPS research, manufacturer, is giving 5,000 only. Suppose you are a manufacturer, I am your dealer. You may give me provided if LG reduces. You are Onida or you are a manufacturer, you give, I am your dealer. Today at what price I have purchased from you? 5,000. And tomorrow if there is no change, okay, if this clause was not there, what is your transaction price? 50 lakhs. When you will recognize? The moment you deliver the TV to me, you will recognize. But today, in this contract, one clause is sitting. Because of that clause, entire revenue recognition structure is going to change now. That clause says that in next 6 months, if the price of the competitor is getting reduced, that much I will reimburse to you. Now this 50 lakh is a fixed or a variable? It became variable. And that variable is unlimited or there is a time bound? Time bound. Now that means today when I deliver TVs to you, will you recognize revenue for full 50 lakhs? No. Why? Because this 50 is a variable now. You may end up paying tomorrow to me. So how much? Sorry? Reimbursement. I may reimburse, not to you. That's what you should tell me now. That you cannot tell that whatever I received is my revenue. Whatever is received is bank account debit. What is credit now? Revenue. That we are talking now here. Bank, there is no dispute there. So now question is, when you passed an entry, if this clause was not there, your accounting entry was bank to revenue 50. With this clause, what is your credit to the revenue? That's my question. Bank account debit 50. To revenue how much? Now standard says, since the nature of the consideration becomes variable because of this clause, you have to estimate. Will you end up paying or will you not end up paying? Because of this, they will make, because they had got an experience to do with similar thing. So they make an estimate and they say that, look, there's a 70% chance that the competitor is not going to reduce. In that case, what is the consideration for you? Transaction price? Full 50. But there is a 20% chance that the competitor may reduce 500. So I have to give this discount of 500 to the dealer. Or there is a 10% chance that I may have to give 1000 rupees discount. Which method of, what is that called? Variable consideration estimation you are going to follow? Have they told you anything? No. So if I follow for, what is that called, most likely method, 50 lakhs. But if you follow expected value method, you will multiply individual values. I think 48, right? And yes, 48 is the consideration. Now what accounting entry will pass then? No, you multiply, no, 500 into 20%, 100, and 1000 into 10%, 100. That means total discount 200 you are planning to give into 1000 TV sets you have sold, no. 1000 TV you have sold, no. It's one, they are talking price reduction 6 months for one, they are talking. No. Number of TV sets. Think, understood, no? Now, what accounting entry will pass? Bank to revenue to contract liability. Bank account 50 to revenue 48 to contract liability 2. Because it's not your revenue, but you received in advance. It's like a customer advance, which you may have to pay back to him. So you say that here expected value will be the best method. So estimated transaction price is 4,800. So you will be recognizing 48 lakhs as a revenue. See, those things they didn't ask you. I am telling you journal entry so that you understand and appreciate it better. Perfect. Next is an RTP question. Okay, I am very much eager for this type of questions because these are all probable questions. Entity I sells a piece of machinery to a customer for 2 million, which is payable 90 days in time. Entity I is aware that at the contract inception, customer may not pay the full contract price. It's same thing like that G&P, competitive food processing machinery. Entity I estimate that the customer will pay at least 1.75 million, which is sufficient to cover my cost of production. That means still I maintain my profit of 2.5. And which entity is willing to accept because it wants to grow the presence in the market. That means on day one only, I have sold something to somebody. I know that that person will not pay, but I am okay. I don't want to take any legal actions against that person. Why? Because I want to granted similar price concession in the comparable contract because I want to expand myself into that particular market. It's like a marketing promotion expenses. Entity I conclude that it is highly probable that it will collect 1.75 and such amount will not be constrained as a variable constraint. That means they said that is a theory, no? Constraint means you should give a very due consideration and see to it that it should not get reversed later. And I am damn sure that 1.75 is the minimum I am going to collect. And what's the transaction price here? Yeah, that's it. But how do you sell? What is your transaction? Is there any variable consideration? Okay, is it a variable consideration? Where? What does the contract says? Fixed, no? Is that says that 2 lakh you will pay only if you like or you don't like and all? Probability like, see, is the probability of a bad debt. Followed, no? Yeah. 1.75 I agree, correct. But it is not a variable, it is more like a provision for bad debt. Okay, anyhow, it includes a variable consideration because you are expecting a price concession. Ultimately, it's like a discount you are offering. If they don't pay, see, Variable. Okay, it's a variable only. It's more like a discount you are giving to them. What entity expect to receive after providing concession, which is not constrained, that's what you need to cover, which is 1.75. XYZ entered into a contract to build a sophisticated machinery. The promise to transfer the asset is performance obligation satisfied over a period of time. At this point of time, again, don't get into that. There are 3 conditions, which we'll see later. See, if it is over a period of time, then you have to use that percentage of completion method and all. The promised consideration is 2.5 crore, but the amount will be reduced or increased depending upon the completion of the asset. Specifically for each day after 31st March, if the asset is complete, consideration will be reduced by 1 lakh. That means any delay 1 day, 1 lakh will get reduced from 2.5, and anything before you complete, it will be increased by 1 lakh. Equal. 31st March is the last day. Any number of days you want to take it. 1 lakh will get reduced. If you complete by tomorrow only, I will add 1 lakh from today till 31st March extra. In addition, upon completion, a third party will inspect the asset and give one credit rating, means performance rating. If the asset received, say, for example, AAA category rating, then we will give a bonus of 15 lakhs. What is my transaction price here? Is there any variable consideration? How many? 2. Because your fixed, this itself is not a fixed consideration. This becomes variable because of the change in the completion, and this bonus is based on the either you will get or not get. Yes. You will take fixed as 2.5, and that additional plus 1 lakh will be the variable. You have to estimate now how much, within how many days I may be able to complete. So you will say that this is most likely, percentage of, what is that called? One is your most likely method, expected value method. So you are going to apply this and the most likely method. So you can practice this theory. So first you explain that there is involved a variability, and you need to estimate each element of the variable using estimation method. In the given case, expected value method suits best for the daily penalty, because there is a broad range. I may finish in 10 days, I may finish in 20 days, I may finish in 50 days. I may not finish in 10 days, I may not finish in 50 days. So you have to calculate probability, and most likely is best for that incentive bonus, which you may get, may not get. So since they didn't tell you within how many days it is going to get expected to take place, so the transaction price is fixed 2.5 plus minus 1 lakh per day. Together this makes it variable. These two things together becomes variable, and always plus, like your question now. There is no minus here. 15 lakh or 0. Okay. AST enters into a contract with the customer to build the manufacturing facility. It is performance obligation over a period of time. Why is over a period of time? Because as and when the manufacturing facility is given, the customer gets the control over it, because you are manufacturing. See, there are 3 conditions. One of the condition is you will get the benefit. You will not get the benefit. No. Foundation is laid. Will you get a benefit? Can you go and stay there? No. But the problem is, the second condition is, as and when the asset is created, customer gets the control. Like in the second condition, the moment AST lays the foundation, who gets control over the foundation? Customer. That's why we say it is satisfied over a period of time. Every stage, like it is not at a point in time. See, difference is, at a point in time means till that time I cannot recognize revenue only. I have to wait for 5 years. At the end of 5th year only I can recognize the revenue. Over a period of time means like your construction contract. On a staggered basis I can recognize the revenue. That's why when I say series of distinct goods, say cleaning, it is single performance obligation at a time in over a period of time. That's why every month I can do the billing. If it was at a point in time, say for example audit, over a period of time or at a point in time? at a point, because you have to have audit service you give only at the end of the year, no? Report. Till that time you cannot recognize revenue. In between, whatever you get from the client, it is a progressive, not a progressive building. It is what you can see. Again, another way we can say it is over a period of time also. We'll explain that. Just to give you an example, audit, whatever is the reimbursement of expenses in between, but the fees you will get at the end of the year, because your work is not complete. Followed, no? Now, this is over a period of time. Construction is scheduled to be completed by 36th month for an agreed price of 25 crore. What is this? Fixed. Entity has an opportunity to earn a performance bonus like 15%, 25% probability, 10%, 30%, and 5%, 15%. In addition, it is entitled to a quality bonus also, 2 crore, and there is a 60% chance that you will receive this quality bonus. What is your transaction price? And in MTP they asked analyze. See, this is the difference between study material question and this. And determine. Analyze means you have to write the theory here. You have to speak about the components. Determine means calculations are involved there. Determine the amount of variable consideration that you should recognize to build the manufacturing facility. Yes, students, so please pause the video. Just tell me, do your calculation and tell me how much transaction price I should consider at the inception of the contract to do the billing or progressive billing. Okay, so very good. You have seen that the probability, this can happen in the exam. Now, what you will consider? If you see the probability, it is 40, 15, 25. That means what is that balance? How much? 20%? No bonus. 0. Followed, no? And if you see, this is your what you estimate. And this may happen. So, which method? Expected value method. For this, most likely method. So, you will analyze, means you will say that there are 2 elements, you have to use the expected value and the range of possible outcomes you may have. So, you go for this probability, you multiply with the probability there. First of all, what is the amount of the bonus? 25. What is the probability that you will get? 15%. So, how much you may get? 3.75. Multiply 3.75 into 25%. You must have done this, no? 25 into 10% is the bonus you are going to get. See, they said what? 15% bonus on 25 crore. If the contract is completed and its chance is 25%. So, what you are probable to get 2.5 is only 40%. 1.5. So, if you add this 2.125, so AST may use most likely method for the other one. And what is the probability? 2 crore or nil? Did you include 2 or no? Included 2 crore, because there is a high probability that you will include. So, finally, the transaction price is fixed price 25. Variable is 2.125, other variable quality is total 29.125. What went wrong here? Sorry? Which method you followed, Baba? Both the places you followed expected value only. Okay, both the method you followed expected value method, but no, that they have said, no. Because if you take sum of this, what is the probability? 60 and 40, no. So what they did? 40 is 0 is 0, 60 into 2 is what they have taken. But see, if you apply, okay, that's fine, I am okay with you, but that's your assumption. Oh. No. See, this can happen in the exam. That's why my purpose was, since theoretically we are discussing, this can be a highly probable question because it has appeared in your MTP with the analysis answer. So, this is what they do. Start everywhere spoon feed with 90%. Create one pattern there. Suddenly they shift to 60%. Now, my point to you is, you have adopted expected value method for the second one. Have they told you, or it is your assumption? Now, when you take an assumption, what is the guideline which I always repeat? First, you give priority to whatever is taken in the study material. For this quality bonus, have you come across any study material question? Come on, this is what we have been doing now. All time we are doing yes or no means most likely. So, we have to apply most likely method here. What they have given? They have used no. Say there is no question. If you look at the question, that it is most likely 60%. That means they may want us to follow the most likely method. Correct? Okay, nice. Anyhow, we will solve some problem. Genuine problems we'll sit and solve. Hardly very few, 10, 12 are there. Other problems you can proceed like this. Now, RTP question. On 1st April, entity X enters into a contract to sell a mobile chargers for 100 per charger. As per the terms of the contract, if entity Y purchases more than 1000 chargers till 31st March 2002, see, this is 1st April you took. The price per charges will be retrospectively reduced to 90 per unit. I have told you. And I have told that, look, go back, like at the end of the year, if your total purchase crosses, then I'll give you retrospective discount. Okay. Till September 2011, like 30th September, 6 months, entity sold 95 chargers to the entity Y. And entity X estimates that the entity's purchase for this year till 31st March 2012 will not exceed the required 1000 chargers. So what is your transaction price here? 100 rupees. How much you received from the customer? 100 rupees into 95. You received it. What entry you must have passed? Bank to revenue. Full 9500 you must have recognized. Why? Because you thought that is there a variable consideration? Yes. What is that? Discount. What do you need to expect? What you thought? He thought that yes, he will not cross hardly 95. In 6 months, 95 he has purchased. Will he purchase 1000 in next 6 months? No. That's why I thought he will not do it. So definitely at the end of the year, I will not give him any discount. So 100 rupees, whatever I purchased, it is going to get, chapter is closed there. So bank to revenue, you must have passed. Now in October, entity Y acquired entity C, which was unknown to you. When you made this estimation, at that time you didn't know that entity Y, your customer, is going to acquire one more customer. So from October to December, entity X sells additional 600 charges to entity Y. Suddenly there is a spike in the demand because subsidiary started asking more charges from you. Now due to these developments, you came at the end of the year now, December. What you decided, entity Y will exceed 1000 charges for the period. Therefore, I have to retrospectively give the discount 10 rupees for all the purchases made during the year. So by December, how much you sold? 695. Now analyze the above scenario in light of India's 115 and state how the revenue would be recognized. Now when that second demand came, suddenly one demand, see, first happened, let us for simplicity's sake, we'll do like this. During this entire year, you had this 1000 rupees, no? On one day, he came and purchased 95 chargers. Before also he didn't buy anything, after also he didn't buy. So by looking at the face of the customer, I thought, what, will he take 1000? May not take. So I passed one entry, bank account debit to revenue. Somewhere in the month of December, he came, he placed one order for 600. I got surprised, Baba, what? How come you are giving this? He said, we acquired one subsidiary and they wanted it. Then I'll ask him more question. What about in upcoming days, will you place order? Yeah, definitely, we may pay more than 1000. That means this time you received bank account debit how much? Into 90. I may receive 100. Yeah, definitely I will receive 100 only because he has not crossed. No, he has not crossed. I will receive 100. But can I recognize 100? No, because I estimate that he may cross. So at what value I will recognize? 90. But what about the previous one which you already recognized at 100? Reverse. Whatever, no, now, see, yeah, that's what I am telling. So whatever new order you got for 600, you may receive 100 rupees. You will receive 100 rupees. Bank account debit how much? 600 into 100, because did he cross that threshold? No, 60,000 only. But to revenue, how much you do? You do 600 into 90 because you know that next year is going to cross. If you simply pass 600 into 100, after 6 months you have to reverse now because of this variable element. You say 54,000. What's the balance? Contract liability. But the problem you face now, already in the previous session you sold 95. Should you not reverse that? Now what you will do? You will deduct this revenue part into contract liability. You pass one more entry, revenue to contract liability. Perfect, no? Understood in terms of journal entry? Very clear? Yes. Now analyze. You say this is story. You see the story here. Entity shall include the transaction price, sum or the variable amount only to that extent where you think the reversal is not going to occur. And you should consider the likelihood and the magnitude. Likelihood means the probability, magnitude means the amount. What are the factors you will consider? Whether outside entities control, not expected for a long period of time and uncertainty, similar type of contract, broad range of products, broad range of possible outcomes. We discussed one theory, no? That theory you have to write here for this answer. This is all because of the analyze part. Now, in the given case, on 31st, not 30th, on 30th September 2011, how much entity X estimated that the consideration is variable, but because of my experience, I know that it is not going to get reversed. So, highly probable that you will not do significant reversal. So, it will recognize full 9,500. Agreed? Now comes 31st March. You understand because of that they are going to exceed 1,000. So, you have to retrospectively recognize 90. That's why this time on sale of 600, you recognize 54,000. And that this is called a cumulative catch-up adjustment. I will tell you later. You do change in the transaction price 95 charges into 10, 950. So, this time you recognize only 50,050. What is your accounting entry? Accounting entry will be bank account debit 60, to revenue 53.05, to contract liability balancing figure. They didn't tell you, but understand the journal entry behind it, whatever you need to do. Management fees. On 1st April, entity enters into a contract with the client to provide asset management services for next 5 years. Mutual fund type of some asset management. Entity receives 2% quarterly management fee based on the client's asset under management. At the 31st March 2012, client's asset under management is 1,100 crores. So, what is that fees? You will be paying 2% quarterly fees based on the asset under management at the end of the year. Do you know what is your asset under management at the end of the year? No. You should make an estimate. But the problem is, can you estimate? No, it is not within your control. You can make some estimation, okay, based on 31st March 2012 at the end of the year, what it may be. See, every quarter you cannot calculate here. Last quarter you can calculate, yeah, last quarter because uncertainty goes no. Straight away you can take 100 crores into whatever. In addition, you receive bonus 20% of the fund in excess of the return observable over a period of 5 years. This is totally impossible unless you close your books. So, by 31st March also you cannot calculate because you don't know. So, analyze. There are two things. One is called a performance obligation. The performance obligation accounts service as a single performance obligation because it is providing a series of distinct services that are substantially same. How many performance obligations are there? One. What is that? Managing the asset. Is it distinct or series of distinct? Why? Because it's substantially same. Every month what you do? Asset management service. No? Every month, what service you are giving? Asset management. Is it that 1 month you give asset management service, second month you give consultancy service, third month investment service? No. Second, you follow the same measure of progress. Like you bill that, whatever billing and all. Now the contract has got two variable consideration, management fees, performance bonus. In determining estimate the each element of variable consideration, you should predict the amount of consideration in which you are going to get. Since it is dependent on the market, it is highly susceptible to factors outside the entity's control. So, though entity has experience in similar contract, it is of less predictive value. So you may be an expert investor, but you cannot invest and tell at the end of the year what will be the value of the investment value. Can you tell on 31st March what is Sensex? Which investor can tell? People will give guessworks there, because your experience has got less predictive value, because lot of factors are going to affect here. But if you are a manufacturer, can you tell by the 31st March how much you will be able to sell? That you have got a control. Therefore, you cannot include conclude that highly probable that reversal is not going to occur. So variable consideration at each reporting day, quarterly management fees at the end of the quarter, it can include actual amount of the quarterly management fees, because uncertainty is resolved. That means every quarter end, okay, what you can do is, you can, ultimately you will pay 2% of end of the year. So what you can do, every quarter end, you find what is the total asset, take 2% of it, and cumulatively you adjust on the last month. So quarter wise, you have to account this 2%. But the performance incentive, no, you don't recognize, because quarter end you don't recognize. You may have to recognize only at the end of the year. Revenue recognition on 31st March 2000, asset under management is 100 crore. Therefore, quarterly management fees, transaction fees is 2 crores. You can recognize 2 crore. However, such entity can recognize only 2 crore as a revenue every quarter, but not the performance bonus. Performance bonus only at the end of the year, not quarterly. Okay, so we'll solve some problems there on this revenue recognition. Yes. Okay, this is some simple example. Okay, a geo entered into so that you can appreciate and understand how this entire revenue recognition works. This is my own example. Just we can read it. Geo entered into a contract with MRPL on 1st of April. As per the contract, MRPL subscribes for Geo's monthly plan of 12 months, and in return, MRPL will receive free handset from Geo. Have you come across this type of offer? You take free mobile, but 12 months subscription you have to take. Now MRPL will pay monthly fees of 100 rupees. The moment you subscribe, handsets are delivered. Because without handset, how can you use this? Jio sells the same handsets for 300 rupees and same monthly plans 80 rupees without the handset. Hello. Now, how the Jio should recognize the revenue from the contract in the year 1920 under Ind AS 115? Tell me. See what happened? You have been given free handset now, just for taking 12 months subscription. And you have to pay 100 rupees per subscription. But if you don't want this handset, only subscription, then I'll give you 80 rupees. You want only handset, but not subscription, I'll give you 300 rupees. Because this problem should give you a very clear idea of how the revenue recognition should happen. Okay, so we'll apply all the 5 steps here, so that you get, before we proceed, know what we are doing. Otherwise, you may be wondering what we are doing here. So first step is contract. Is there any contract? Yes. Second, how many performance obligations are there? How do you decide that it is true? Sorry? At the product level, how many are there? At the contract level? 1. Is it integrated? No, that is not that. You only pay, you not pay. See, in 100 rupees, you promise 2 things, that I will give you handset also, I will give you connection also. Handset is free. MRPL is very happy, but you don't know. MRPL, nobody can be happy for getting something free, because that free is loaded somewhere else. I told you, we discussed it. So now, when you are going to pay, but when you will pay? From next month onwards. And what handset you have got free? How many performance obligations are there? At a product level, there are 2 promises. At a contract level, is it integrated? Is it interdependent? Is it customized? No. Then I say there are 2 performance obligations. I can use somebody's this thing, no. You say without the handset, okay, this is going to work, but can I have only handset but not this? Yeah, I can sell this handset to somebody. MRPL can buy the handset and sell to third party. So there is a standalone value is there. Okay. So what is my consideration here? Transaction price. First thing, is it fixed? Is it variable? Is there any variable consideration? No. Is anything payable to the customer? Is it significant financing transaction is there? Component is there? No. And is there any non-cash consideration? MRPL will give oil and all, crude oil to Jio? Nothing. That means there is only one payment, 100 rupees per month. Total consideration, 1200. Now, since there are 2 performance obligations, see, like step 1, there is a contract. Step 2, there are 2 performance obligations. One is a monthly plan, another is a handset. They are not integrated or not customized or not interdependent. Transaction price is 100 into 12, only one fixed consideration. No up also, no down also. Now, since you have got the transaction price, 1, which is 2 performance obligation, you have got into a need to allocate it. On what basis? On a standalone selling price. So, you have got your standalone selling price is 960 because you say somebody without this handset, they will give it 80 rupees. Handset independent price is 300. So, you allocate it and you give 914 and 286. Followed? So, you allocate 1200 to 2 people like this. Why? Because there are 2 independent performance obligations. No? Sorry? For lease contract, no, lease, sorry, how did you do it, lease contract? Lease contract, yeah, exactly, yeah, very good. Lease we have done, no, distinct this thing, allocation between lease and non-lease. One lease having multiple leases. There was one practical expedient was there. Truck and driver, very good, nice. This is what we have done there also. Now, how much revenue you should recognize? 76 rupees per month. Why? Because it is a series of distinct or it is distinct. Why? Because substantially same, not every month, substantially same, irrespective of the period of the contract, and it is the same pattern of transfer. Is it distinct or series of distinct? Distinct. Only once, no. You hand over this, will you hand over handset every month? Will you hand over the handset every month? It is once, it is a distinct. Will you give network services every month? That is why it is series of distinct. Next goes revenue recognition. For this first thing you have to see, this performance obligation is satisfied over a period of time or at a point in time? Over a period of time. Why? Because it is a series of distinct. As and when I give network services, whether you use it or not use it, you have got the benefit. This performance obligation is set over a period of time or at a point in time? At a point in time, because you deliver it, you recognize it. So, since it is over a period of time at a point in time, the day you deliver the handset, even though you didn't get any money and you said it is free of cost, you need to pass one accounting entry, contract asset account debit to revenue from handset. And this is not customer account because there is no, you have not fulfilled your other part of the performance obligation. And you cannot go and ask money also, give me 286 rupees. You will ask what is 286? Customer is supposed to pay 100 every month. See, that means you understand how much knowledge you need to have about the IT systems also. Because what you account versus what you recover from the customer is totally different there. How the reconciliation is going to happen, how much customer paid, how much I billed him. And what you bill him, what you recognize as a revenue, may not be what you tell the customer to pay. Billing 100 rupees every month. Every month I will bill 100 rupees to the customer and he has to pay me. So at the end of the year, when I raised a billing, what accounting entry I pass? Customer account debit to revenue and then bank account debit to customer. But when the customer pays me 100 rupees every month, 76 rupees only I will take it for the revenue from this network services. What about the balance? I will take that from the contract asset. Perfect. Beautiful accounting, no? Now you see what you can hide. If you want to give bundle, but something will come and it's all going to create a problem for whom, Baba? Us only, accounting department. Best thing you could have told, no? Take 300 rupees and every month pay me 80 rupees. Clean. First PUC person we can call and pass this entry. But now you will ask me what is this 76, where this 286 came from? Because this is bundled. Like this is going on for next one. Are you clear? Yes, Krithi. Sorry? 60 rupees discount got allocated. Yes, very good. Later part will come now. It's called allocation of discount. There is one exception to it. The 60 rupees got discount allocated to network service and handset. 14 rupees to network because 300 rupees minus 14 rupees you gave, 286. 960 minus whatever differential, no? 54 or whatever you gave for this. And why you didn't allocate discount to one item? Because there is some rules for allocation of discount. It's called on a standalone basis, you should sell on a bundle of products. The discount what you offer to the bundle should be substantially into the bundle in the contract. And all those rules, what I'm telling you, should be there on tip of your tongue. You should tell, you should write there. This bundle will not allocate, this discount will not get, variable consideration that will allocate to this, will constrain it. Okay, perfect. Yes, so we'll move on to the second question. On 1st of January, entity J enters into a 1-year contract with a customer to deliver water treatment chemicals. Over a period of time or a time, okay. Distinct or series of distinct? Series of distinct. Not required, I'm just telling you so that you get used to it. Why? Because it's a series, it's the same pattern. The contract stipulates that the price will be adjusted retrospectively once you reach certain sales volume. Now for 100 rupees for up to 1 lakh, 90 for 1 lakh to this, 3 lakh. Volume is determined based on the sales during the calendar year only. There is no minimum purchase requirement. Entity J estimate that the total sales value for the year will be 2.8 million containers based on the experience with the similar contract. So what you thought at the beginning that, see, this is the slab rate. How much you will end up selling? 2.8. That means which rate will be applicable? 90 will be applicable. But from day one, whatever they buy, you will charge him 100 rupees only. Contract liability. And the day he crosses this, he will continue to pay 90. And whatever you have accumulated in contract liability, you may have to pay back. Otherwise, what happens? You recognize 100 means you have to reverse the revenue. But did you knew? Okay, let us see. You estimated this. Entity J sells 7 lakh containers to the customer during the first quarter. So you will receive 7 lakh into 100. But 100 you will not recognize. For a contract price of 100 per container, how you are going to determine the transaction price? Okay, right? We'll write one solution. If this question comes, we will solve this, and I hope by that time you will be very clear about this. The transaction price is rupees 90 based on estimated total sales price. Agreed? Any confusion for anyone? No. Your transaction price is 90 rupees. At this price, significant reversal of revenue will not happen. What you say that, look, if I consider 90, because if I consider 100, I will start recognizing on 7 lakh containers 100. Suddenly 70,000 I may have to reverse it later. Rather than from day one only, if I start recognizing 90 and keep that amount in contract liability, the day I have to give the discount, what I will do? Contract liability account debit to cash I will do, no. It's not going to hit my revenue. So excess rupees 10 will be contract liability for first 1 million containers. So you will explain how it is accounted. You say that my transaction price is so and so. At this price, significant reversals are not going to happen. Third, if anything excess I more than this 90 rupees I am going to reverse, that I am going to treat it to transaction contract liability. I am going to accumulate it. So on 31st March 2018, J will recognize how much? Can you tell me how much revenue I will recognize? Rupees 63 million. How did you get? 7 lakh containers into 90 rupees and contract liability of rupees 7 million, which is 10 rupees into 7 lakh. That's it. Update the estimate every year. Yes? 2.8 is the expected value during the entire year. Sales volume for the year will be 2.8 millions. This is J sells the 7 lakh containers to during the first quarter. So this is 31st March, not year ended, Q1. I think the year is 1st January to 31st December. In the first quarter, no, 7 lakh is what you have sold. So quarter ended, you will recognize only this much and balance you keep in the, and at the end of every quarter, you are going to re-estimate it. Easy, right? Simple, no? Do you have any questions? Now you understood my pattern, no? When I ask this question, and I can see immediately I went to the next question, correct? Yes. So please pause the video, do this. Everybody face this problem in the examination. Think now, and that's what I tell you, it may look okay. That's why unless you are very sure about revenue recognition, don't touch revenue recognition problems. Yes, students. So please do this question. Let us compare the answers. Did you see the catch here? 14 mark question. Okay, let us see. ABC supplied the plastic bucket to wholesale customers. As per the contract, ABC entered into for 1920. Price per plastic will decrease retrospectively. Same story. Now they have given you this slab rates also. By this you understood that this is an examination study material question. So we will give it a try. Now suggest how the revenue is to be recognized in the books of accounts of ABC Limited as per expected value method, considering probability 15, 75, 10 for sales volume of 9, 28, 36. What you are supposed to do? Apply the expected value method, check how much amount you get. That slab you have to see which will be applicable. In case ABC decide to measure revenue based on most likely method, how you will recognize revenue? So which is the most likely sales? 28,000. For workings, assume that you achieved the same number of units what you initially estimated under most likely. That means whatever you assume, it is the same thing. Actual also same. Pass the journal entries in the books if the revenue is accounted as per expected value method, not see. Entries you have to do as per expected value method. Let us compare now. First of all, since expected value you wanted a probability, you would have multiplied 9,000 into 15%, 28 into this. So total quantity came to 25,950. Did you get this number? And you have to tell me any mistakes happening. Then you achieved what you thought, you got achieved. So what accounting entry, how much revenue you will recognize? 25,950, and that this slab will be 80 rupees. So 2 lakh, 20 lakh 76,000. But problem is, This 25,950 is issued in stages. Let's write this revenue. Then first 10,000 units when you sold at 90 rupees, revenue will be at 80, contract liability will be 10 rupees. For subsequent 15,950, revenue will be 80 and contract liability will be reversed. Have you done this? Is this number have come? Have you given this breakup? That there is a contract liability, it will go on the slab basis. First thing, because they said very clearly that what you estimated is what actually happened. Previous question which came in the study material, what you estimated was 25. What actually happened was 7 lakhs. In this question, what you estimated is 25,000. What actually happened is also 25,000. But the 25,000 went through slabs. So ICA has given a solution like this. They say that 9 lakh units estimated value sale price. So average selling price is 79.13 per unit. They say you 9,000 into 15% probability into 90 rupees into 80 rupees. No. But with the grace of God, they said alternatively students could have solved it with the 25,000. Otherwise you would have asked me what type of assumption it is. They said that you could have taken what you have solved versus you could have multiplied with the price also for different slabs. You could have taken that way also. Very confusing manner they have given the suggested answer. Yes, tell me. Something happened. You have done this method. It doesn't matter. Well and good. That's what. No, some student what? And it came for the first time. Precedence was not there. So how some students will look at it, God knows. But now why I recommend the first method? Because when it comes to journal entry, you get the irritating thing. If you don't follow the first method, no, journal entry will happen easily. Yes. This way, okay, no problem. Now they said that look, alternatively you could have done this way. So I have taken that assumption. Anyhow, I showed you both the assumption. Otherwise you would have asked me, sir, I would have done this way. Now if it is most likely method, you should take 28,000. There is no question here. So average price will be 80 only. So since you achieve 28,000, 22,40,000 will be recognized in total. This number is there in your workings. So again you will write for the first unit 90, 10 will be the contract liability and balance 18,000, I will go to reverse it. First 90 rupees what you sell, you recognize revenue at 80. So what about that 10 rupees contract liability? Because when the first unit 10,000 units, you estimated today that you will sell 28, but on when first 10,000 happens, do you tell customer or customer will come and tell you? No. So billing happens at 100, 90 rupees only. No. It's not once. Okay. Somebody could have assumed that way also. Straight away some order came for 20,000 like I told you first. No contract liability, straight away everything. But if you think practically, that doesn't happen, no. When you have that 28,000 you got with a probability. And it is a very rare, no, miracle, that's called a miracle. That happened, but happened in stages. Now what you are telling, sir, what happened, since the question is very silent, you are telling that what we estimated it happened at once. That is called a miracle in life. Very, very remote chance that you estimated one number, that number only some customer came in, place an order. So the best assumption is what you estimated must have happened in stages. I got your assumption. Tell, no problem. They have given you two ways of doing. You could have done that way also. Okay, journal entries they asked only for the third one. So you will have bank account debit 9 lakhs, revenue will be 8 lakhs, contract liability was 10 lakhs. And then for second set, bank, contract liability to revenue. Did you get this number? Huh? How it is possible? Because up to 1 lakh, your bank was totally different, no? 9 and second, you added both into, means you must have done it like this, bank account plus, how did you do like this, 10,000 into 90 plus 25,009? Yeah, 59,500. But what your theory explained? What theory you explained there? You explained first 10,000, next 15,000. Okay, anyhow, it's a, yeah. Okay, so the second part of the entry will be same, what you would have taken, that 79 point whatever. I don't have it. Anyhow, you understood the scheme of entries, no? So you understood how a question is going to come on revenue recognition. This is the contract liability which you have taken here, because you have to reverse now, you have to pay them now. Because he paid you how much now? 80 rupees only he paid you on 25,950 minus opening. He will pay you, see, when the customer, when he goes to the second slab, he will deduct that and pay you balance. Did he pay you 80? He must have deducted, no. Because previously, he paid you extra 1 lakh rupees. When the second slot of order is placed, you will not get the difference. That's what you get, the net difference here. You assume that it's paid. All right. Do you think commercially how, your assumption is fine. Commercially how it will happen? You have to pay 100 rupees to me. Okay. So yeah, when I have to pay you some money, I will deduct that and pay you. No. Will I pay you first and take you money? Double transaction I will do. So this is one. You think from a commercial angle, what must happen? Next question. HT Limited enters into a contract on 1st of April to sell product X for 1,000 per unit. If he purchases more than 1,000 units, it is the retrospective discount of 900. First quarter ended, entity sells 10 units of product A and it will not exceed 100. HT Limited, if there is no problem, it will not occur when the result. I think we have done this similar question there. One RTP question was there, no? Now further in the May, customer acquires another product, another entity and sells additional 50 units. In light of new, the customer will purchase is going to exceed 100 units threshold. Determine the amount of revenue. Okay, so I wanted to show you one thing here, one calculation. Otherwise the same question like that RTP question. Okay, write solution. In second quarter, I will write a small theory, okay. Volume discount in second quarter, volume discount to be adjusted to revenue. This is called a cumulative catch-up adjustment. That means, you remember last time we have done that 95 into 10 rupees, 950 we adjusted. No, first question. Same thing. Here we want to explain that, look, in the given case there is a, you can recognize 100 without any volume discount, but in the second quarter you recognize because this adjustment will be happen. See, no need to write it, I am just telling you. When it comes to quarter two sales, understand this concept. There are two ways to get the quarter two sales. One, independently what is applicable for quarter, or you take YTD sales method. See, whenever you do sales for the period, it will have catch-up adjustment. Like what problem we have done? See, what is catch-up adjustment? If you see only this quarter sales, how much is only this quarter sale? Only in the second quarter, how much did you sell? 50 units. Into, at what price? 900. So 45,000 is your quarter sales, correct? But the problem is, in the first quarter, did you recognize excess sales? Did you recognize excess sales in the first quarter and the second quarter? Yes, how much? Minus 100, no, 10 units only you sold, no? Into 100, 1,000 rupees. So you say, see, my actual only quarter sales is 45, but since in the previous quarter I recognized excess sales, this month I will recognize 44. Or YTD sales works like this. Till now, how much sales you did? 60 units. On 60 units, how much sales you should have recognized? 900. 900, no? How much it comes to? 54,000. How much you recognized in the first quarter? 10,000. You recognize full 10,000, no? Minus 10,000, you get 44,000. See, both the methods will give you the same amount. This method is called a YTD. See, please understand this difference. This method is called a YTD sales method. In YTD, year to date, that means you start again from 1st April. See how much till now should I have done, minus how much I did in the previous quarter. Balancing figure is the YTD. Whenever, see, this is a very simple way of doing. Very simple way. But if you do this way, you will lose step marks, because ICA wants you to do this cumulative adjustment and this 1,000 rupees. So I will tell you later, okay, how to do that. So catch-up method, calculation of revenue. We will go for the catch-up method. Q1, Q2. What is your selling price? Or what is your transaction price? Transaction price is 100 units, sorry, 1,000 rupees into 10 units. You took 10,000 rupees. When it came to quarter 1, your transaction price was 10,000. Was there any adjustment? No. Less cumulative catch-up adjustment was 0 for the first quarter. Understand, always remember, for the first quarter, irrespective whether you follow YTD method, whether you follow quarterly method, it is one and the same. Cumulative quarter adjustment will happen only subsequent year or subsequent quarter. Are you clear about this concept? First quarter, it doesn't make any difference only, because it's the first quarter, no. Cumulative catch-up means whatever pap done, no, mistakes done throughout, that you adjust now. It was a mistake, no. On day 1 only, if you knew, you would have recognized 900 into 10. You would have recognized 9,000, but you recognized excess 1,000 there. So that cumulative, see, that means on day 1 doesn't make any difference there. So what is your revenue? 10,000 only, but this is with the mistake. What is your transaction price in the quarter 2? Dash 900 rupees into 10. Sorry, 50. You sold 50 units, no? In that quarter 2, what is your actual sales? 45,000. If previous mistakes were not there, you would have credited to revenue 45. To revenue 45. Whatever debit, because this is the proper revenue, 900 into 50. But in the past, you have done one mistake. Because of your wrong estimation, you have recognized excess revenue of 1,000 rupees. So that adjustment you do here, 100 into 10 rupees, 1,000, if you minus this revenue, so 44,000 you recognize. Are you clear, students? Sorry, 1 minute. Sorry. Yeah, I'll explain that. So this is what you have done under catch-up method. So where you have taken the, see, this is your transaction price, but this estimation was wrong. This is your transaction price, this estimation is correct. When the estimations are correct, whatever transaction price are there, you will recognize it as a revenue. But when you followed a cumulative approach, you will deduct that cumulative catch-up of 100 rupees, because excess of 900, no, into 10 units, 1,000. So that's why in the first quarter, you recognize a revenue of 10,000. In the second quarter, you recognize revenue of 44,000. Now, how did you get this 1,000? See, you will make one working note number 1. cumulative catch-up adjustment. How much is total products of Q1? 10. Retrospective discount 100. So 1000 is the cumulative catch-up adjustment. Alternatively, you could have done here also. You have done it in the bracket. But I suggest you please give a separate working note for this amount. Cumulative catch-up adjustment. How did you get this 1000 rupees? You say that in the previous quarter, I sold 10 units. I should have estimated with 900 rupees, but I gave 1000 rupees. So excess 100 rupees I extra recognized. So 1000 rupees is my adjustment. Are you clear? Now, why? See, YTD is a very simple. I will show you now. YTD no headache at all. But this method, no, this step will carry you 1 or 2 marks. This particular step. Now, if at all you would have done YTD method, see, you remember revenue 10 and 44. YTD method, how it is going to work? Don't need to do it. See, first is selling price how much? 1000. YTD units sold 10. So first quarter you recognize 10,000. Already did you recognize anything? No. What is the transaction price first quarter? 10,000. Did you recognize any revenue in the previous quarter? No. This is the first quarter. No, I told you no. First quarter, whether cumulative catch-up adjustment or YTD approach, it doesn't make any difference. When it comes to Q2, what is your transaction price? 900. And what is the total quantity sold? 60. So it comes to 54,000. Minus what you have recognized here? 10,000. 44. You get the same amount, 10, 44. But if you see, is there any cumulative catch-up adjustment entry? No, it's already sitting in this 10,000. Have you understood the difference? Yeah, because next question, it has got an implication. Next question, I will do, see, next question I will do in my way, YTD method. Institute has done at the cumulative catch-up method. I'll show you that. But a very important question, please mark it very important. Okay, understand this question. Very nice, beautiful. Entity has got a fixed fee contract of 1 million. 1 million means 10 lakh rupees to develop a product that meets a specified performance criteria. Now, estimated cost to complete is 9,50,000 rupees. So, how much is your profit there? 50,000 is your profit. Now, entity will transfer the product over 5 years and uses cost to cost input method to measure the progress on the contract. So, this is over a period of time. Now, this is more like a construction contract. So, use input to cost input means what? Same thing. In your interview had done, no? Estimated cost minus actual cost, how much percentage of work is completed into the revenue value, contract price. Sorry? That is how much revenue I need to recognize proportionately. Now, incentive award is available if the weight of the product what you develop is more than 951 grams, no incentive. If you give this less than less, you get 2,50,000 or 1 lakh rupees incentive. How much is your contract price now? 9,50,000 is fixed, but there is one variable element. That variable element you may get or you may not get. Followed, no? And what is the probability of this? See, what you will get? Either you will get not get anything, or you will get 1 lakh rupees of this 10 lakh, or you will get 25% of this. So, since a variable element comes into picture, should you not estimate? Which method you will use? We'll see. Otherwise, we know that there are 2 ways of estimation: expected value method, most likely outcome method. The entity has got extensive research in creating product that meets the performance based criteria. Based on its experience, entity identified 5 engineering alternatives that will give you 10% incentive. Definitely, sure shot. See, first of all, when somebody gives me incentive, There is no way that I am going to leave it because I have got an experience. Now, there are 5 engineering alternatives in which I can manufacture this product. 5 engineering alternatives will give me 10% and 2 will give me 25%. Now, in this case, entity determined that it has got a 95% confidence that it will achieve 10% incentive and 20% confidence it will achieve 25% incentive. So, which alternative will choose? It will choose among 5 or among 2? Among 5. See, there are 5 options, different options to manufacture. I can outsource and do it. I can do it in-house. I can buy, manufacture, something like that. God knows. Now, if I do this, there are 5 ways. I may get 10%. If I choose this, I will get 25%. Now, since I have got 95% confidence that if I choose this option, 10 is better to get. It is like 1 in hand better than 2 in bush. Which one you will think now you will go for? You will go for the first alternative, and definitely on day 1, you must have included 1 lakh because you followed most likely outcome method. Have you understood this? Because they said no, it is 95% confidence that it is going to achieve 10% and 20% confidence it will achieve 25%. 10% of that's what they told here. 10 lakh is the fixed contract. That is definitely, whether you get the weight or not get the weight, they will give you. Plus, if you achieve this weight, they will give you 1 lakh extra. If you achieve this way, 2 lakh 50 extra. But here there is one catch. If they said 95% confidence that you will get 10%, 20% confidence that you will get 25%. But will it add to 0, 100? Then how to interpret this? What they are trying to tell? How? Not like that. You have to read it like this. See, that's what is the confusing thing. You have got a 95% confidence that you will get 10%. You have got 5% chance that you will get 0%. If you go for 5 engineering alternative. There is a 20% chance that you will get 25% and 80% chance that you will get 0. Now tell me, among this option, which option you will choose? Anybody will choose this option, no? Because that's what I am telling you. 1 in hand, 2 in bush. This is better, no? Which is high probability. So based on this analysis, entity believes that the 10% is the most likely amount in estimating the transaction price. So what is the transaction price today? 11 lakhs. 10 fixed plus 1 variable. So they include, sorry? Variable. 1 is fixed, 10 is fixed, 1 is variable. Therefore, it included only 10% transaction price by calculating the revenue, and it is concluded that significant reversals are not going to happen. Same story here. If subsequently, that means they decided that if it is going to use this, definitely then there is no need to reverse any revenue. On a conservative basis, they took. Somebody could have been aggressive and told, no, I will take more. Follow, no, this percentage distribution. Now what happened? Entity reassess the production status quarterly, whether it is on track, and at the end of year 4, that means 3 years, you recognized revenue with the 11 lakh. But when it came to the 4th year end, because it always happens like this, no? When we are far away, we don't know. But when you are almost near, we get a very clear idea when you are going to complete it. So at the end of the 4th year, it is becoming very clear that you will get full weight based criteria. Therefore, they revised their estimate to include 25%. Because at that point of time, it has become probable that you are not going to reverse if you include 2 lakh 50. So what is your transaction price now at the end of 4th year? 12 lakh 50. Out of 12 lakh 50, some percentage of completion is already done. If you knew on day 1, how much would have been transaction price? 12 lakh 50. And every year you would have increased more revenue. So now you have to calculate a cumulative catch up. One big adjustment is going to come for the 4th year revenue. Because already you have done some work. You initially thought 1 lakh you will get, and you took say 25% of it, 60% of this, something like this you got. Suddenly you came to know that in next 2 years I am going to do it, but when this amount got increased from 1 to 2.5, what you should have done on all the first 3 years, that amount cumulatively you will adjust in the 4th year. Cumulatively adjust in the 4th year. This is exactly similar to that previous term where you didn't knew and you thought 100 rupees is the revenue. Suddenly you come to know that, okay, previous quarter I should have given only 90 rupees. The 10 rupees for whatever units sold, you will adjust in the second quarter, no? Same story. Now evaluate the impact of the changes in the variable consideration when the cost incurred is so much. Because why they gave me, in the first question only they told it is cost to cost input method I need to follow. Okay students, so I will do one method, okay, which is different from what ICA is doing. Because my method is much simpler to understand, it will give you accurate answer. But I strongly recommend, again, please go through the study material also, try to understand it. Okay. If you don't find time, if the same question comes, you can take a risk, write my method. If you have got sufficient time, you have understood that also, do that method. Now in the December 21 examination, this question came, calculate, see, revenue, that means is the no theory. Calculate question, no theory. Revenue. See, when they said calculate revenue, does it matter whether I follow cumulative catch-up method or whether I will use YTD method? I will give my revenue, no? Operating profit margin, percentage of gross profit they are asking. Does it matter which method? I'll give it. For simplification purpose, calculate revenue for the year independently based on the cost incurred during the year divided by the total expected cost, with the assumption that the total expected cost not. That means they are talking percentage of change method. Calculate the revenue independently based on the cost incurred during the year by the total expected cost. Okay. Note, in practice, this is what they have studied in the suggested answer also. In practice, under cost to cost measure of progress, total revenue for each period is determined by multiplying the total transaction price by the ratio of cumulative cost incurred to estimate the cost complete less revenue to recognize the date. That means they are talking in reality, practically people follow YTD method. So my suggestion is please check that method also, okay, where we have done that cumulative adjustment. This is not given in the suggested answer. Or probably we have to follow this method because they said you use this, calculate the revenue for the year independently on the cost incurred to be divided by the total expected cost. Okay, 1 minute. Okay, so what we'll do, I will show you my method. But in this question, since they very specifically told that divide the total cost for the year for the estimated cost for the year independently. So they want you to follow the, not the YTD method, but they gave a note telling people will follow YTD, but in examination they don't want you to follow YTD. Followed, no? I will tell you, so in this question, you should be very clear about what is the difference between YTD and the cumulative catch-up method. But in this examination question, you are expected to not to follow YTD method because they said calculate revenue for the year independently based on the cost incurred. So we have to follow the cumulative approach method. But I will show you both. Okay, right. Revenue is recognized based on the percentage of completion. And assumed cost has not changed over the contract period. Yes, because they said estimated cost. No, estimated cost has not got changed for simplicity's sake. See, whenever you follow YTD method, first working note 1 will be percentage of completion. Always calculate percentage of completion. If whenever they give you YTD method, yeah, this is some simple thing. In fact, not required because the verb used was calculate. It's just an assumption that the cost didn't change. So always give the first working note completion of percentage of completion. So we have got year 1, 2, 3, 4, 5. So how much is my estimated cost? First year 9,50,000. Did it change? No. Third year, did it change? No. So total estimated cost remains same, no, which doesn't happen in reality. Only for simplicity's sake, it will happen like this. Estimated cost remains same. How much actual expenditure did you incur? YTD. First year, you incurred 50,000 rupees. Second year, can you tell me how much you incurred in the second year? Plus 50, because I am told YTD, no? We are following YTD approach now. So it is 2,25,000. Third year, 6,25,000. You add first year cost, which is 50, 1,75,000, 6 lakhs, 4 lakh. Then add 2,75,000 to it, 9 lakhs. And you have perfectly reached 9,50,000 by the end of the year. Very simple, plain question. And what is your percentage of completion? First year, against estimated cost to cost input method, you estimated 9.5, you incurred only 50. So 5.26% work is complete. Very small amount. Second year, 23.68% is complete. Third year, 65.79% is complete. Like this, you have completed 100% by the fifth year time. You see, YTD method is so simple, so beautiful, but they don't want that simplicity. That's why they adopted another method. I'll show you now. Now you will understand the difference. So YTD level, you always calculated. How did I started my journey? I started with 5.26% complete every year, 23%. Like this, you went on. Yes, next calculation of the revenue to be recognized. Total 5, 4, 3, 2, 1. 1, 2, 3, 4, 5. I'll write the total at the end. What is your fixed consideration? 10 lakhs. Is there any variable consideration? Add variable consideration. How much? 1 lakh. Because on day one, you didn't know. You thought you are going to achieve 1 lakh. That you came to know only on the year 4. On day 1, it was 1 lakh only. So what is your transaction price? 11 lakhs. How much percentage completed? 5.26%. So how much YTD revenue? Because you calculated YTD percentage completion. How much YTD revenue you should have done? 57,860. Did you recognize minus previous revenue? 0. So how much is your revenue for period for the year? 860. Minus, what is your actual cost? 50. So how much profit? 7,860. Why? Because they asked you that percentage of profit or amount of profit. 50,000 is your cost, which is your actual cost, not YTD cost. Because finally you got actual revenue here, not YTD revenue. Yes, first year P&L is done, balance sheet is done, annual report came, board of directors approved. Understood now? It goes like this. Second year, did the transaction price changed? No. It was 11 lakhs only. Because fixed, variable you didn't change. How much percentage of work is completed? 23.68%. As per that, 2,60,480 you should have recognized till date, starting from the inception of the contract. Did you any recognition has happened? 57,860. So you minus that, you get the revenue only for the second year P&L account. How much cost incurred in the P&L second year? 1,75,000. If you minus the cost, you get the profit for the second year. Simple, right? Second, no, see, if you deduct from here, you have to cumulative. But what you are deducting? You are deducting from here. No, but this is revenue for the year. So this will go into the P&L every year. This will not go anywhere. This is only a calculation, which happens in an Excel sheet. Follow, no, students? Very important. Huh? Practice both the ways, because I don't know what type of twist they will give. But give first priority to the another method, not this method. I'll go to the third year. Same story. Percentage is how much? 65.79. 7,23,690. Are you clear? Yes, students. So please pause the video and do till year 5. Sorry, yeah, year 4 there is one change happening. 1 minute. Sorry, what you said? We deducted, no? Because this 260 includes your this also. This is YTD, because when you say 23.68, does it include 5.26? Yes, that's why when I say I will deduct this. Now I'm sorry because I told you please continue, but there is one change happening, no? What is your fixed consideration at the end of year 4? 10 lakhs. Is there any change in the variable consideration? Yes, 2,50,000. Yeah, going on. 2,50,000. So your total consideration becomes 12,50,000. How much you completed? 94.74%. 11,84,250. Yes, Vishnu, how much revenue I will deduct? 723,690, because this was a cumulative revenue till date. So whatever adjustment that your past mistakes were there for 3 years, that means this 2,50,000 actually has got 2 breakup, 2 years and 3 years. If you knew on day 1 only, your every year's revenue would have been more. That cumulative adjustment will get adjusted in this, and your 4th year revenue will automatically got adjusted. 460, 560 automatically get adjusted because of this. If you follow YTD method, which is practiced in practice. Tomorrow you go to any company, no? You see this method. That is an irritating method there. Other thing. So what is my 5th year? Same story. 12,50,000, very easy now. 100% complete, 12,50,000. And YTD revenue is 11,84,250, 65,750. Are you done? Can I proceed further? Now, if you see, okay, you could have clubbed this with the previous working also, calculation profit for the year. Profits, no? We have done that, no? Every year we used to deduct 7,860, 27,620, 63, 85. If they ask you revenue separately, do it separately, otherwise you can club it with the previous one. Because in the study material they have clubbed and given single one. I have a slit here. So you should get these numbers, this is your profit. Now, yes, we are done actually. But if you follow this method, to get the step mark, you have to do cumulative adjustment. Only to get a step mark, if you follow this method. Otherwise, you follow that full method, okay, write cumulative adjustment. Now, how much increase happened in the year 4, net increase? See, 1 lakh though by default included. You increase your consideration by 2,50,000 minus 1 lakh. The net increase was 1,50,000. If this estimation was not changed, how much you would have included in the year 4? 1 lakh only. How much you included now? 2 lakh 50. So additionally 1 lakh 50 you included, but that 1 lakh 50 was meant for all the 5 years. So how much is portion pertaining to previous 3 years when you didn't recognize? Can you just tell me? I want to know. See, this 1 lakh 50 is meant for all the 5 years based on the percentage of completion. First 3 years you didn't include only, no, 1 lakh 50. So if I want to ask you, in this portion, what is the portion pertaining to 3 years? What is the portion pertaining to this year and next year? Amount 90? 90,000. How did you get? You are using percentage of completion method no there. How can you use a straight line method 3 by 5? 0.79% of 1 lakh 50. That's it. So this amount, if you knew on day 1 only that your variable consideration was 1 lakh 2 lakh 50, till now 98,685 revenue you would have recognized more for all the 3 years together. So this is one adjustment which will happen in the revenue of 4th year. Are you clear? Okay, we are done with this answer. Now I will show you one reconciliation. What is my only revenue for if year 4? 12 lakh 50 into what is that percentage of completion happened only in the year 4? 94.74 minus. That means this year, can I say only 28.95% work happened? How much revenue I should have recognized? 50 into 25, 3,61,000. How much I recognized there? What is the difference? This is this 98,000 difference. If you add that, you get that 4,60,000 rupees. That's what I was trying to tell you, that cumulative adjustment of 98,000 is sitting in this 4,60,000. Because in reality, the revenue of the 4th year should be only 3,61,000 for 28% work completed. But you recognize more than that. Why? Because that 1,50,000 extra, if you knew on day 1, eventually in a 3-year period, you would have recognized 98,000 more. This part is very clear. Now I'll show you ICA method. What ICA has done, they said, look, your total fixed consideration is this much, estimated cost is this much, this is your actual cost. Estimated variable consideration is this much. So what is your yearly fixed revenue? It is A into C by 9,50,000, which is nothing but percentage of completion, 5.26% of this. How much is your variable consideration? 1 lakh into 5.26%. How much is like this? They have done individually every year. Now, if you see the 4th year, since they have done individually every year, how much is the total consideration? You understood now? How did you do it? They found out individual cost divided by the total cost. Individual cost divided by the total cost. Individual cost divided by the total cost. Like that we did YTD percentage of completion. No, they went, when you do individual cost by the total cost, you will get percentage of completion that year. 4 lakh by 9,50,000, how much it comes? Sorry, 42%. Okay, 42% into 1 lakh, 4,21,000. Yeah, 4.21%, 42% plus 4,105,000. Like this, if you take these two revenues, how much it comes to? 2,89,474 plus 72,368, 3,61,842. You remember this number? I told you, no, only for the year 4, this would have been. Now for this, they calculated that cumulative adjustment as a working note number 1, added this, and they said, this is my total revenue. And if you see your working, every year these revenues are matching. But the 4th year, they calculated yearly revenue, added cumulative adjustment. And at the same time, note also they gave that in reality, people don't do like this. People do the following second method. But in examination, you do this method. Followed, no? You understood this? You understood the difference between two ways of working? Okay. See, again, if the question is totally silent, follow YTD method. If the question again in your attempt, it says that follow your actual cost to the total cost for the year, then follow this method. Don't follow YTD method. You don't find time, last moment something is there, then follow YTD method, close it and try your luck. Okay, cumulative catch-up adjustment. Okay, another way of catch-up adjustment they have given. I have done in a very simple manner. Okay, so this is the amount. Updated variable consideration, total variable to be recognized minus actually recognized. Okay, this question. Yes, students, so please pause the video and do this question. We'll compare the answers. Yeah, students, so please do this work question on the second method, not the YTD method. Followed, no? You please understand this and do it in the second method. My PDF is available for verification. Second method means this method, ICI method, not YTD method. So that you have done both the ways. Followed, no? Yeah, my method looks simple, but I wish please do it this way because of one particular note given here at the end. Independently cost incurred, this. Yes, we'll compare the answer. Yes, students, you can pause the video, we'll compare the answer.